If you're watching a YouTube channel dedicated to finance and business, I'm almost certain you've seen The Wolf of Wall Street at least a dozen times. It's an incredible movie that's inspired many around the world. However, there's one line that still angers me 7 years later.
An IPO is an initial public offering. It's the first time a stock is offered for sale to the general population. Now, as the firm taking the company public, we set the initial sales price, then sold those shares right back to our friends. Look, I know you're not following what I'm saying anyway, right? That's okay, that doesn't matter.
No, it does matter. Jordan Belfort himself said that the movie was only loosely based on his book, which was loosely based on reality. Many things were intentionally left out of the book because they could be considered proceeds of crime. Similarly, many things were left out of the movie. But that's okay because you have me. It's time to learn how money works, delve into Stratton Oakmont's questionable operations, and understand how it let Mr. Belfort rake in almost $1 million a week in ill-gotten gains. Please like this video and subscribe to my channel to support me. Jordan Belfort's career really picked up when he was laid off from his job at L.F. Rothschild, a New York-based stock brokerage. Before the 2000s, buying stocks wasn't as simple as going online and typing in a ticker symbol. People would actually call a real living person, a stockbroker, and give them instructions on what stocks to buy and what stocks to sell. Usually, it worked the other way around. The stockbroker would call their clients and tell them what stock to buy and sell. In the 80s, you had to wait for tomorrow's newspaper or call your broker to know the stock prices. So why did they do this? Yes, that's right. They earned significant commissions by processing these trades. Nowadays, we're used to commission-free brokers, but it wasn't always like this. In the 90s, trade costs could be up to 2% of the total value of the assets being traded. A stockbroker would typically get 1% of that, and the firm the stockbroker worked for would get the other 1%. OTC companies are different. Exchange services are not used and therefore eliminate many of the regulations and oversights that come with them. Companies can go directly to these OTC companies and say, "Hey, I need $1 million to research and develop a new radar technology that has military and civilian applications." The stockbroker will say, "Sure, but we keep 50% of all the money we raise for you." Another issue is that the 50% number was just a bit of Hollywood magic. OTC brokers probably did only 10 to 20% of these trades. However, it should be clear that any company that needs to give a stockbroker 20% to raise money is probably not worth investing in, which is why Jordan Belfort and his colleagues resorted to high-pressure sales tactics on unsuspecting investors. Jordan eventually founded Stratton Oakmont, a subsidiary of Stratton Securities, a small dealer that could trade both private and listed companies. Belfort and his partners, Brian Blake and Danny Purish, who were portrayed as Donnie Ossoff in the 2013 film, later bought the entire company and began to change the way it operated. Belfort was making good money doing it, but he had bigger ambitions. He hired a team of stockbrokers, each of whom aggressively sold whatever stock he told them to. Before giving this order, he would contact trusted but unrelated contacts who would buy a large amount of stock in a small company, preferably with a market cap of less than $100 million. When his connections, affectionately called rat holes, owned enough of the company, he would order all the brokers on his sales floor to sell the stock to whoever would buy it. The rush of buying drove the price up, which subconsciously made it easier to sell to new investors. This stock has doubled its value in the last week. Enter now or you will miss out. When the stock price reached a certain level, Jordan instructed the rat holes to start selling. While this was happening, Jordan's company made it extremely difficult for their regular clients to sell their stock. Brokers were instructed not to answer phone calls from investors looking to sell or to intentionally lose trade orders. This gave the rat holes time to exit their positions, and as soon as regular investors could start selling their own stock, the price would collapse. The rat holes would then give the money they made to Belfort while keeping a small cut for themselves. This scheme reached its peak when Stratton Oakmont started taking companies public. An initial public offering, IPO, is when a company is listed on a public exchange for the first time. This process involves many rules and regulations, but the advantage for the business is that it becomes much easier to raise capital from public markets. Companies hire an underwriting firm to guide them through the process and assume some risk of the whole operation. The underwriting firm is responsible for ensuring the IPO is successful, which means selling all of the shares the company wants to sell at or above the agreed-upon price. Usually, companies go to investment banks for underwriting, but at its peak, Stratton Oakmont managed to court several companies to use their services instead. You might have thought that the reintroduction of public exchanges into the mix would have slowed down Belfort's scheming. But Jordan didn't let that stand in his way. In fact, he developed a system to get the best out of both systems. Jordan would instruct the rat holes to buy up stock in a company that he was about to take public. The company would then debut on the public market, and he would instruct his army of brokers to sell the IPO to all of their contacts. This would drive up the price of the stock just like it did before, but this time, because it was listed on the public market, it attracted other investors who didn't even know what Stratton Oakmont was. People just heard the news that an IPO had gone up by 50% at the opening and then wanted to invest in it. Then, brokers could use this buying frenzy to quietly sell off their own shares and make a substantial profit. Jordan effectively combined the illegal environment of over-the-counter trading with the trust that investors had in public stocks to create the biggest money-making scam. And that's how you can make $22 million in 3 damn hours. Another part of the movie showed how Jordan hid the money after making it. I don't have time to cover that in this video, but fortunately, I am making a full video on how exactly he did it. Special thanks to the channel members and supporters. Stay successful and wealthy.